Welcome to this edition of Feeley Driscoll's videocast. This is the second segment in a three-part series entitled Managing Fraud Risk in Your Organization. My name is Mike Downey. I'm an audit director at Feeley Driscoll. In the first segment, we spoke about common fraud risks in small and mid-sized organizations and also discussed common means of fraud through cash disbursements. In this segment, we're going to discuss fraud through payroll as well as cash receipts and accounts receivable. In a number of instances, our audit firm has uncovered fraud that has been committed through payroll. This can occur whether or not an outside payroll service is being utilized. So if payroll is being processed in-house or if payroll is being processed by one of the larger payroll companies, it does not necessarily matter. The common controls that are generally lacking when a fraud is committed through payroll is the lack of authorization over pay increases for individuals. Additionally, the authorization to add new employees to the payroll or controls over employees that have left the organization. For each of these actions, ownership should be involved in authorizing pay increases, or management should be involved in creating new employees. In the event that one individual handles most of the activities within payroll, any changes to that individual's pay rate should be authorized by ownership. There should be a monthly reconciliation between the general ledger payroll accounts to the payroll records on a monthly basis. That being said, having looked at payroll records for the past 13 years and doing it approximately a couple dozen times each year, I can be confused when I look at a payroll register coming from ADP, Paychex, or even coming from a client software. It's extremely overwhelming to look at each individual and all of the company contributions as well as the employee contributions. As a result of that, most owners, when reviewing payroll, simply look at the gross figure. They want to be sure that each of the employees are authorized to receive a certain amount of money and that that's the amount of money that's being included in the gross pay. However, most frauds aren't necessarily perpetrated through increasing an individual's gross pay. Rather, these frauds are committed by editing how much of the funds that are contributed either to a 401k, health insurance, etc., are contributed by the company versus how much of the funds are contributed by the employee. For instance, an individual that controls the payroll can set themselves such that their entire 401k contribution is contributed by the company as opposed to through payroll deductions. Additionally, be wary of small or lesser known payroll servicing organizations. There have been a handful of organizations that have, over the past few years, that have processed payroll for organizations and have not remitted the payroll taxes to the federal and state governments. Eventually, the payroll service organizations go out of business. However, the organization is left with a large amount due to the federal government or to the state taxing authorities. Lastly, encourage as many employees as possible to be on direct deposit. In a number of instances where manual checks are utilized, we've had clients that those, in the same way that vendor checks can be copied and cashed, I've had clients where manual paychecks have been copied and cashed in the identical amount a number of times before the fraud was detected by the bank. Direct deposit eliminates the risk that a third party can get their hands on a paycheck and repeatedly cash that check. Moving forward to billing and accounts receivable, the most common area of fraud within the billing and cash collections area is that employees are able to take customer checks and to cash them, either endorse them over to themselves or to cash them in a bank account that's been set up under the company name. To minimize this threat, the individual who has access to the mail and who is handling the bulk of the cash receipts that come through the door should not be the same individual who has control over the general ledger. And this is a very very simple way, particularly within less sophisticated general ledger packages where an individual may receive a check that has been written to the organization. They set up a bank account under a similar name as the organization that they control, and when the check comes in, they simply take the check to cash in their own bank account and then go into the QuickBooks general ledger system, for instance, and delete the original invoice because QuickBooks does not have strong controls over that action. When somebody's reviewing the accounts receivable aging, it'll appear as though that amount was paid in full, whereas the company never deposited that amount. A simple way to avoid this type of fraud is that any other individual within the organization, whether it's a receptionist, an owner, anybody outside of the individual that controls the general ledger, should receive the mail, segregate checks, and make a listing of which checks were received that day. In the same way, many general ledger packages allow for authorization over accounts receivable credits. There should be a system in place to authorize credits to accounts receivable. Lastly, either a lockbox prevents this by the fact that the cash receipts are never received by the organization. Rather, the bank controls the cash receipts. The side effect of this, of course, is that it also cuts down the float on the checks between the day that they're received and then deposited and credited to the account. Lastly, more and more organizations are scanning cash receipts right within their offices. For this, they're utilizing bank-provided scanners, and this simply eliminates the possibility that a check is lost between the client's office and the bank. This isn't necessarily a fraud risk as much as it is the risk that a check can be lost going to the bank and then copied by a third party fraudulently. In that event, it won't necessarily affect the client or the organization as much as it affects their customer, who will experience aggravation in trying to rectify the situation. In the next segment of this videocast, we will be discussing some other common areas of fraud through monthly and regular company expenses, as well as some other miscellaneous areas in which fraud may occur. We will also review an internal control checklist that we go through with each of our clients in order to identify fraud risks. If you think that you or your organization may be subject to fraud, or to evaluate your organization's susceptibility to fraud, please contact our office at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you.